Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, I'm going to talk about the what I think is the most underrated concept when it comes to velocity banking. So the phenomena is called segregation of income. Okay, and I first learned about this when I took a velocity banking class back in 2017. Now, keep in mind, I made 20 grand a year and I was never going to qualify for a line of credit or even a mortgage back then. Definitely not. And I was like, why am I taking this class? It's such a waste of time. And what's funny is that, I absorbed all these concepts. And then when I was ready to play the game, aka ready to buy my first house, um, I paid off 25% of it in 1 year. And I was like, whoa, mind blown, right? These concepts are really powerful. And this is why I teach it as well. So, what is segregation of income? Well, basically, think about this: your paycheck comes into your checking account, and you have to pay all these debts, right? So, think about this person right here who has 14 debts. Okay, and this is a real life person who emailed me out of the blue, six figures. In fact, this channel is like the number one reason why I've encountered so many six figure people who are broke. Right? It's always the same scenario. They make after tax 6 grand, 7 grand, even as much as 10 grand a month, and they have all this debt and it's all over the place. Right? So they have all this debt and it's all over the place. And so what happens with a lot of people, especially if they make great money, if they're living paycheck to paycheck, money comes in a checking account. That paycheck is split in, especially in this case, 14 different places, and we wonder why we're broke, right? And so the beauty of velocity banking is that we're trying to prevent that phenomenon by making sure our paycheck just goes into one place, right? And so I'll just give you an example here. So for example, let's say, so right now we're not doing velocity banking, and this is somebody actually sent me these numbers where they have as much as 4 grand in debt payments, just debt payments, not in your general expenses. So there's more, like $2,000 more in general expenses in addition to these debt payments. And so what he was doing is just doing the average American way, paying, getting from the checking account, and then splitting all your money in different ways up the wazoo. Now, with velocity banking, what we're going to do is put our line of credit as our main operating account, and we put our entire paycheck into that line of credit, right? It comes to the checking account, goes all the way into the line of credit. Well, not all the way. It's just a click of a button on a website, but you get what I mean. And just guess what? When you put your entire paycheck here, this goes to zero, right? You see that? So I'm going to reverse that. And so this was 4 grand. And when you put your entire paycheck in here, you put that 7 grand that he was making, guess what? We freed up cash flow just by simply changing our method, right? And that's a really powerful concept. And one of the things that people don't take for granted is really that most of personal finance is not based on a mathematical equation, it's based on human behavior. Even Dave Ramsey says this. Like when he talks about like the debt snowball and debt avalanche, he says that doing the debt avalanche is actually mathematically more efficient or something like that. But you shouldn't do it. You should do the debt snowball. Why? Because every debt that you pay off actually gives you more psychological motivation to pay off the other debt. Now, I totally agree with that. Now, he probably wouldn't recommend the HELOC because he's very anti HELOC or any type of debt. But, I just think of these things as tools that you can use when they're appropriate. And one of the main things that I think is mind blowing about why it's so easy to, or why I like to use a line of credit is just because it prevents segregation of income, even if it's your very last debt that you pay, right? So if you're, I'm just going to show you one of my spreadsheets that I always do. So if you're the average American and you're trying to pay off your debt, it's very unlikely that you only have one or two debts. In fact, somebody actually commented on my channel and said, I only have one debt left, which is the mortgage, and I have lots of rental houses and $4,000 in cash flow. You know what I said to him? I said, "You win at life. You don't need velocity banking." That's what I said. But for most people, what happens is that they don't just have one or two debts, right? They have five debts, six debts, as many as 14 debts, like this person. Okay, and in order for us to win with debt, we have to prevent segregation of income. And the way that I think about a line of credit, even if it's the very last debt that you pay off, it's kind of like a safety belt, right? A safety belt that prevents you from adding additional payments when it's not necessary. Okay? So and I'm just going to kind of make a point about this, about how a lot of people think that, once you're at this point where you paid off this debt and your mortgage is your very last debt, you don't have to do velocity banking. Now, here's the thing. If you're at this point in life where you have $915 in savings, okay, it's very unlikely that you're going to get from here to here without a very easy action plan. And velocity banking helps that because you're putting all of your money into one place. So if I go back here, you're putting all of your money into your HELOC and then you transfer debts accordingly, which we show in another video, to that HELOC to increase your cash flow, right? And so if we go back here, we want to go from here to here. Now, at this point, yes, you can actually put your entire savings, which your cash flow would be your savings at this point, to the mortgage directly. Now, what's the problem with that? Number one, this is the default option for all Americans with a mortgage. Yet the average American does not pay off a mortgage in 30 years or anywhere close to that, right? Like, I think if I recall correctly, the average payoff for a mortgage is like 52 years. So if they have this option to put their savings into the loan, why don't they do it? They already know they can do that. Well, think about this. If I put my savings into a loan, I cannot get that money out ever again until the loan's paid off. Or I do a cash out refinance, which will mean that I might have to go through underwriting. I might have to pay broker's fees, right? I've done a refinance before. It's a lot more expensive than I thought it would be, right? And I was forced to do it because I had a 1 year balloon loan. And I was like, wow, this is a lot more expensive than I thought, right? But back to my point. If you ever put this cash flow here, which will be, at this point, would be your savings, directly into your loan, you can't get that money back. Now, a lot of people say, well, okay, you have these two credit cards, right? Why don't you just use a credit card as a backup? And I'm going to say something that I think if I had told myself as a teenager, you're insane, but really think about how we got where we were originally to where we're at now, right? So when we were, originally getting started in life, we didn't have any debt. And we said, okay, I'm going to take on debt. Okay? Oh, okay, I'm going to take on this loan. Oh, I'm going to take on this extra payment. Every single extra payment that you add that is unnecessary is going to lead to segregation of income, right? So some of you might be thinking, okay, well, if this is your last debt, why don't you put your entire cash flow into the mortgage? Now, you can definitely do that, but why not put on a safety belt or maybe a bike helmet while you're riding the bike? I hope that makes sense. Or maybe the safety lanes while you're bowling, right? Because that's really what the line of credit is going to help you at this point, right? So what you can do is prevent segregation of income, right? Prevent yourself to ever going back here. So let's say this is like, you've paid off everything, and then the mortgage, wherever the mortgage is, I think, oh, it's this one. The mortgage is the last thing you want to pay off. And you say, well, this is a 2.99% interest rate, and this is a 10% interest rate. Guess what? You could still pay it off quickly, just as pretty much the same time, but you still have that bike helmet or safety belt, right? Because you're going to prevent the segregation of income. And not a lot of people talk about that, right? Like people are comparing, like, well, if we do HELOC versus the, paying extra payments to the loan, it's pretty much going to be the same. I'm going to be honest with you, right? There's a reason why I don't do velocity banking demonstrations with just one loan versus a HELOC, because it's pretty much going to be the same, right? In fact, I actually watched a video from I think someone named Financial Coach Jess, where the latest video was like, it's pretty much the same, exactly. But whenever I do a velocity banking demonstration, I always start from here. I never start from here where you just have one mortgage or one loan, right? We never start from there because we're up to debt to our eyeballs, and we're going to figure out how to prevent the segregation of income. Very powerful concept. Okay? So once we do that, we just want to make sure that we can transfer some of this mortgage to this line of credit. And I don't know at what point I'm at, but let's just say, like, I don't know, $5,000, right? We move $5,000 to that line of credit and use our cash flow to pay it off. Guess what? It's just pretty much like making extra payments, but we're preventing segregation of income. Because let's say I put my entire paycheck into the mortgage, right? Then, oh my goodness, $1,000 credit card emergency, okay? And then, I don't know, maybe like, well, this wouldn't be $1,000 payment, but you get what I mean. Like, then we have another emergency right here. Now, and then we have an extra two payments, right? And then that's going to be a slippery slope to going back to this situation again. Now, you might think I'm crazy. You may not believe in slippery slopes, but that's what the older people talked to me back in the day about how if we let XYZ happen, it's going to lead to a slippery slope. In fact, let me go to look at the definition of slippery slope. But basically, it says an idea or course of action which will lead to something unacceptable or wrong or disastrous, right? And I used to make fun of this when I was a kid. I was like, what? You know, these little tiny inconsequential actions don't mean anything, and people are not that stupid. And I realized that, yes, having an extra payment once you have a credit card as a backup is essentially slippery slope. And it's not because you're stupid, it's because it's going to lead to segregation of income, right? That's what it is. And so a lot of people get like all riled up about, whether extra payments versus velocity banking is more effective. Now, mathematically, they're pretty much the same, right? You're basically using your cash flow and you're using a higher interest rate line of credit if this is your very last loan, especially if it's a lower interest rate, right? But again, if you prevent the segregation of income, there's a reason why I am able to pay off my mortgage in 25% of a year versus the average American who has this option and is refinancing because they can't manage their cash flow and are making a 30-year loan into 52 years, right? Think about that. This is the default option of overpaying our loan, and it's somehow leading your average American to refinance or sell their home to make it a 52-year loan, right? We have to look at what the default is and what I'm doing. What I'm doing, I prevented the segregation of income. Therefore, I could have, if I never learned this concept, in fact, if I had never learned this concept, I never would have thrown my extra cash into the mortgage. I'm going to be honest with you. But what I'm saying is that there's an easy way for us to overpay without thinking about it that saves pretty much the same amount of interest, and that actually helps you get there, right? Think of it like a seatbelt. But because most six-figure earners don't have that seatbelt, they every time they need extra money, their income becomes more segregated. In fact, you know what's crazy? I've seen a lot of these people who've emailed me take out debts like those buy now pay later. Like, what are you doing? Like that's this, someone who's like making 6 grand, 7 grand, 10 grand net or not net after tax should never get like one of those buy now pay later loans. Again, that's like the total segregation. You're just adding to the more, to that phenomenon, right? It's crazy. But again, a lot of people don't take this seriously, and a lot of people just think that this is just some sort of stupid thing that's not real and it's not slippery slope. It's a totally real concept, and it's a reason why so many of you who are, again, I'm not laughing at you. I just have this like laughing virus. Well, I don't know if it's a laughing virus. Ever since I came back from California, I just like laugh at things for no reason. But it's why so many of you are paycheck to paycheck and making incredibly good money, right? But think about this, right? So previously, I had this. Hold on. 499 payment, right? Previously, I had this 499 payment, and then once I'm able to put my money in one place, bam, I increase my cash flow. In fact, I'm so tempted to do velocity banking right now, right here, but I just want to go over the segregation of income concept. But what I would do is, if I were this person, is I would just do the cash flow index to figure out the debts that I would pay off, and then just put my entire paycheck and move the debt, and then I'm going to have my debt paid off in no time, and then my mortgage is going to be my last debt, right? And then I'm still going to use my HELOC because I'm trying to prevent the segregation of income, even though it's my last debt, right? All right. Well, hope that makes sense, and hope that you understand why this is such an important concept that I don't think a lot of other YouTubers talk about. Like, I don't really explain velocity banking in a way where it's like, oh, line of credits are always better than loans, because they're not. Right? Loans have their uses. If I had somebody selling me a $1 million apartment, right, at a 1% loan, I would take that over a 12% line of credit for $1 million apartment, right? Maybe it's like one of those huge Class A apartments. I don't know, but I would still have a 50 per. Maybe I might still get a 50 or $100,000 line of credit at 12%, just as an additional tool. But I'm not simply not going to say, oh, loans bad, lines of credit good, or oh, just move everything into a line of credit, right? That doesn't make sense. I'll go over that in another video. Okay. Well, this is Curry in Atlanta Mentorship. If you are interested in not only learning about velocity banking, but other things like real estate investing, other topics of financial literacy, go ahead and click the Google form link below. Other than that, have a great day. And please, 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 we must prevent the segregation of income. Okay? All right. Talk to y'all later.